Okay, let's keep going. Again, this is the second part of the video handout slide for slides 13 through 28. If you're in one of classes with me, if not, we're discussing adjusting entries. Okay. It says here, the adjusting entry to adjust supplies was omitted at the end of the year. This would affect the income statement by having what? We have four choices here. So, before we get into what the correct answer is, what I'd really rather do is show us what was the entry that was omitted. Okay? What entry did we not make that we should have made? Okay, so if we think about it like that, we would say that we should have debited supplies expense, and we'll say for $600. Okay, that's our debit, supplies expense. And then we would have credited either supplies or prepaid expense, depending on how our accounts are set up, for the same 600. So what we have here is we have a situation where expenses are understated. Okay, so assuming that revenue is correctly stated and revenues are understated by $600, that means net income is ultimately going to be $600 too much. So if we look at these choices, let's look at choice A. It says expenses are understated. That's what I just said. And therefore, net income overstated. I couldn't have said it much better myself. Not surprising. Choice A is the correct answer. We don't even have to look at the rest of them because we know that choice A is correct. All right. These two questions are fairly similar, but we're going to go through them. For the year ending December 31st, Orion Inc. mistakenly omitted adjusting entries of $1,500 of supplies that were used, kind of similar to what we have right here. Number 2, unearned revenue of $4,200 that was earned. Okay, so they had unearned revenue and then they part of it. They didn't make that entry. And 3, insurance of $5,000 that expired. So here we're talking about a prepaid expense asset, and we've used up part of that asset. That means we needed to expense it, and evidently we did not do that. For the year ended December 31, what is the effect of these errors on revenues, expenses, and net income? Okay, so let's do this. Let's see here. They want to know revenues, expenses, and net income. They want to know those three things. So our first item says $1,500 of supplies that were used. Well, this represents, again, supplies expense. We just did that in the previous question, except that this time it's for $1,500. So we have an expense that was not recorded in the amount of $1,500. That's supposed to be a dollar sign there. Okay. Second thing, unearned revenue of $4,200 that was earned. That means we have failed to record $4,200 of revenue. So all of these items are understated. All of these are understated. And then number 3, insurance of $5,000 that expired. We needed to expense that. Our journal entry would have been that we needed to have was a debit to insurance expense for $5,000 and then a credit to prepaid insurance to bring that asset down by $5,000. We didn't do that. So we have another expense that we didn't record. This one for $5,000, and if we add those two together, we have $6,500 in expenses that are not recorded and $4,200 in revenues that were not recorded. So what is the what is the impact on net income? Well, we had now I want you to stay with me here. We had $4,200 in revenue that we didn't count. That's right here. $6,500 in expenses, that's negative $2,300. But here's the thing. Because the expenses that we didn't count are $2,300 more than the revenues, the impact is $2,300. And technically, that's all we have to say. Because it just says, what is the effect of errors on revenues, expenses, and net income? So we need to be a little bit more specific. Revenues are understated, expenses are understated, and net income is overstated. Okay? Overstated. Because there were $2,300 in expenses net between the two of these that didn't come off of net income. Okay, so while revenues are understated and expenses are understated, understand that when we understate expenses, that causes net income to be overstated. Okay, now we offset part of that because we made so many mistakes, but ultimately net income here is going to be overstated by $2,300. Looking at our last question here, it says for the year ending December 31, Beard Clinical Supplies mistakenly omitted adjusting entries for 1, $9,800 of unearned revenue that was earned. 2, earned revenue that was not billed of $10,200, and 3, accrued wages of $7,000. And they want you to do the exact same thing. So we're going to do just that. We're going to do the exact same thing. We're going to put revenues, expenses, and net income. And then we're going to go through these items one by one. If you did the first one, you should be able to do the second one, although I think our result ultimately is going to be a little bit different. $9,800 of unearned revenue that was earned. Well, we added it up here. We said that that was $4,200 understated, so it's going to be $9,800 understated here. So let's go ahead and write that down. And I'm going to put a U there to show that those revenues are understated. 2, earned revenue that was not billed of $10,200. We need to understand here is that this revenue was never recorded either, okay? Because billed and recorded are actually separate things. So the wording here could use a little bit of improvement. So we never recorded this $10,200 either. So here we have a deferral that was unrecorded. Number 2 is an accrual that was never recorded, but for $10,200. So we're going to add that here as well, and it's also an understatement. It's just that one is a deferral and one is an accrual. We add these two together, it comes up to $20,000 of revenue that has been understated. Accrued wages of $7,000, that would be wage expense, but we never recorded it. So we have expenses of $7,000 that are understated. Okay? So, what is the impact on net income? Well, we're going to subtract. We have revenues of $20,000 that we did not record, so that's bad. That means our revenues are understated. If revenues are understated, net income is going to be understated. But we also have some expenses that kind of offset that, but only $7,000. So our impact on net income is $13,000, and net income is understated as well. This example actually is probably a little bit easier to see. It would have been understated by a full $20,000, but then we had this mistake where we didn't subtract out enough expenses, so the net understatement to net income ends up being $13,000. Okay, let's wrap this video up and we'll get the last handout for the chapter started next.